All right, good morning, and we are live, and good morning to everybody who's catching us today. Welcome to Money FM. I know that you haven't seen my face for a little bit. I know that even Sunday was supposed to be, but we had a bit of a technical issue. But yes, we are back in the stride of things. Vernon, how are you doing, my brother?
Fantastic. We are wonderful. How's your morning looking like today?
Good, good. And it's time to get kicked off and ready. So, everybody, let's get into Finance Tuesday, where we're going to be running through quite a bit of information. We're going to be talking about pension and retirement, biggest mistakes people make, handling those towards the end. While we're also going to be touching on a few big stories that have hit on today on the markets. But first things first, let's check out how the markets are doing. First things first, Vernon. Today is the 23rd of May. We got 1 week left into the month, and so everybody catch us on. We're going to be looking throughout the end of this. At the end of this week, we're going to be getting inflation data. Remember that that's a big one, and trade data. Going into the second quarter, and also inflation data for May to see whether we've got this trend that's going to finally start pulling down on inflation, or whether it's going to continue speeding up. Remember, we're back into double digits with inflation. So let's get into the market roundup. As we've seen today, the kwacha has continued losing value. Dollar is sitting at about 18.9232. That is the interbank rate that we're taking a look at, and that is at 0.84%, up from yesterday, up 2.03% from the last week, and 8.77%. We've had a very strong dollar rally in this last week. Maybe that's just because of the recovery on the bounce back to where it actually was. Remember, the dollar hit as high as 21, danced all the way down to the low, as low as 17, and then it started to come back up. So this is it coming back up 8.7% just in the last 30 days. There's been a bull run effectively. The golden death spiral is showing that it's in a bull run. MACD is showing that it's in a buying direction, even the RSI. So all indicators are pointing to a buying dollar. At the moment. So this is kind of where we are at the moment. We did see that stock market yesterday did trade downwards. Both of the major banking stocks, Zanaco and Standard Chartered, did shave off some of their gains. They've had a very strong year, but they shaved off some of their gains. So the stock market was down 0.2%, but still at very all-time high regions, up 11.08%. Remember, the stock market, for anybody who needs to remember this, the stock market was as low as the 4,000, in fact, 3,000 back in 2020. So just remember, you're looking at a stock market that is almost 2.5 times where it was just from 2 years ago. That is the recovery that it's been through. But remember, it went through a horrible loss, back to a recovery. These are still in all-time high territories for the stock market. Bond market up 0.71% yesterday, continuing on its run, while in dollars it lost about 0.75%, mainly because you can see the difference is really just because of the loss in dollars yesterday. That's why you're seeing 0.75% loss in US dollars. And then interest rates are down to 23.9863. This is a sign of interest. This is a sign of bonds probably selling on the secondary market. You did see that last week we did have that article that showed that NAPSA did announce that it has bonds if it has to liquidate. So if, in fact, as it's making payments out, because I know up to date it's made about 4.5 billion kwacha worth of payments, and it's heading towards 5. Probably they are liquidating some of their bonds on the secondary market, and you are finding some of the financial institutions purchasing them to help finance some of this. So they do have adequate amounts of cash, but they also do have adequate amounts of bonds which can be liquidated quite simply. Remember, banks are kind of easy to liquidate bonds. Part of what I always say to some of even some smaller entrepreneurs is keep a stock of bonds in case you need access to credit, because that always acts as very good collateral for your business. Banks love treasury bills and bonds as the best form of collateral for you for your business, especially if you're running any form, and especially if you don't have any hard assets. Maybe you're a service business. One of the best things you can do is keep financial instruments in case you need access to credit for any purposes at all. Yesterday, we also did see that the rand continued upwards, up 1.46%. And year to date, the rand is still down 7.96%, but on the month, it's up 2.11%, and on the week, up 0.8. So this is inflationary pressure that might be coming into the system. Again, remember, cross-border traders go to South Africa, buy things in rands, and they come back. To that 2% increase in the rand price will reflect in the cross-border traders' cost of doing business, because they have to buy rands to buy the products, then come back in with them. So anybody who's doing cross-border trade all the way to South Africa might end up coming up with slightly inflated products, and that's how inflation can creep in through the rand. So 2.11%. And remember, South Africa is our biggest import source. So whenever things are coming in through Rand, we're going to expecting that kind of cost. Dollar year to date is up 4.5%, up 8.7% on the week. So we are seeing that the dollar has been in a full swing, 30 days of continuous loss. We've gone on another losing spree with the dollar, while we're seeing that the Rand, 55% of the last 30 days, we've seen it on a loss. Other news that we're seeing is that the bond market, as we said, up 0.17% year to date, up 10.83%. Remember, there's a bond auction coming up this week, 2.6 billion worth of bonds are supposed to be coming into issuance. We'll be telling you what prices we are expecting for all those who are usually in the loops that I go into. You will see that also interest rates are probably expected to stay the same during this bond auction. Not much is expected to change because remember, the status quo hasn't changed. And also international investors are still at bay dealing with what's happening in America until we start to see that debt ceiling conversation dealt with our internal debt issues also dealt with. I doubt you're going to see any offshore investors coming in buying up bonds. And usually a signal, by the way, that offshore investors are going to invest in GRZ bonds in Zambia is what they first do is you'll see the Kwacha rally very strong. You'll see a strong Kwacha rally, then you'll see a bond auction buy-up. We have not seen a strong Kwacha rally. We have not seen a secondary market bond buy-up. These two things have not happened. So that's a signal that you're not going to see offshore investors participating. NAPSA is currently at the point where they have to sell off whatever assets they can to make sure that they have the liquidity to meet any of the requests from people, because people are their NAPSA. Those who probably, and my advice I always said is somewhere between 40 and 45, probably the best age to withdraw it. But people are withdrawing their NAPSA. They've decided to get some of it and start to invest it. So what you need to start looking at, obviously, is that NAPSA is not participating. Offshore investors are not participating. Banks are trying to probably lend as much as they can. So participation in GRZ bond auctions right now, it's probably not going to happen much. So it's probably interest rates are set to either stay flat or go up. I don't see them going down anytime sharply. So the environment is not heading towards it. So for this month's bond auction, prepare yourself. Probably going to have an open field for all of you. That doesn't mean going with extremely high interest rates, because remember, your government is selective. They're not selecting higher than expected bids. In other words, because you're at the stalemate of the government, that's okay, not borrowing, and they'd rather not spend on things or wait for revenue. And then you've got this market where the major players are kind of stepped back and they're not fully participating in the bond market. Therefore, you've kind of got this bond auction that's sitting at a stuck place. There'll be under subscription unless there's rollovers. But right now, it's not the end of a quarter. Probably next June is maybe when you'll find rollovers coming in, unless there's rollovers, which they're not. So at this point, just expect a flow back in of the regular rates. So if you try and go too high, you'll probably get rejected. Just stay in exactly where you are, but I doubt it's coming down anytime soon. So that's probably the read you'll get from this month's bond auction. In terms of commodities, we did see copper prices come down 1.31%, while oil has been hovering around that 75 steadying, and gold came down 0.43%. All of these are dealing with the U.S. debt ceiling. This is what is holding the whole commodities market, the whole stock market, and the whole of the global market at bay. America's treasury might run out of money if it cannot open up the borrowing spigots by the 1st of June. That is 7 days away, when we are actually 7 to 8 days away, when we're actually likely to see an American potential default. The last time America defaulted, the whole world went into spiral, okay, and then eventually recovered. But when they default, the ratings agencies downgrade the U.S. And when the U.S. gets downgraded, everybody now starts they start running haywire, just start pulling their money out of all parts of the market. And it happens temporarily, but it creates kafwafwa, kerfuffle, chaos, whichever word you want to try and look at to try and use right there. But all the commodity markets are reflecting what is happening in the US in terms of the debt ceiling conversation. So that's why it's highly unlikely to see offshore investors coming in. What they are investing in are very short-term instruments, and they're pushing the interest rates up. Because right now you're seeing, for the first time in a long time, Vernon, short-term US Treasury bills are trading at 5% interest. 5. Now, for Zambians, you're wondering, what? 5%? That doesn't sound like much. For an American who's used to getting 0.25%, 5% is a lot. Okay? Remember that American inflation is 2%. So when you start getting 5%, right now, yes, they've got pretty high inflation sitting at around 6 to 5%, yes, but 5% interest on short-term instruments, 4% interest on their bonds. There's no incentive for these people to go outside because they're getting pretty decent returns already in their market. So that's what they're really trying to go after at the moment. Now, taking a look at your wealth insurance assets, you did see that Bitcoin did go up by about 0.8%, Ethereum up 1.1%, and gold up 0.41%. This was all due to the spike in the US dollar and the flatness of these assets. But everybody is taking a joint breath in. They're not really doing much right now as they're waiting for Speaker McCarthy and Joe Biden to come up with an agreement of whether the U.S. debt ceiling can come up. Speaker McCarthy is trying to say, look, we can raise the debt ceiling, but please, man, at some point you have to stop borrowing. We can't keep borrowing into infinity. There has to be a point where we stop and we actually start running off taxes and running normally. And Joe Biden and his progressives are saying, no, we can keep making money out of thin air. I'll tell you one thing, Vernon. The other side of this is empires collapse because of what America is doing. The American government, if you study monetary history throughout the world, one of the things you'll learn is that every major empire, be it the Greeks, be it the Lydians, be it the Romans, everyone, the moment they tried to manipulate currency and they overdid it, it always led to the collapse. Even the Chinese went through this in the year 600, back when China really came into being one of the top economies. Even the Chinese went through this. They printed money and it destroyed them. Back then, when they used to use paper, they converted to paper. The others used to use what's called currency debasing, where money used to be what we called electrum. An electrum was something where they put gold and silver together. And what they used to do was, because copper was abundant and it was easy to get, they used to fit copper into it to debase the currency so that they could put more coins into circulation. As a result, the moment they did that, every single empire got destroyed. I am seeing that America's obsession with printing money and creating more and more money without a fast enough growing economy is probably going to lead to the eventual collapse of their state. Eventually, I don't see it happening tomorrow. I don't see it happening next week. I see it happening eventually. And eventually could be 10 years, 20 years from now. But they're on the road to doom. Even Ray Dalio said this, the way these guys are doing things, this is not going to last. You can't print money and expect your economy to continue growing without actually having tangible economic growth and production underneath it. But anyway, that's up to them. That's their issue. What say ye, Vernon, before we get into the next part? Your microphone's low. No, unfortunately, your microphone's off. Let's see if we can get that. Your microphone's low. We can just hear you in the background. Unfortunately, let's see if we can eventually get you back. But let's get into the next section very quickly. So what we're seeing right now across the markets is we're seeing that the bond yields are up 10.8% year to date. Obviously, that's up 4.7 year to date. We're seeing stocks also up as well, while we're seeing stocks also up 11.1%, but they were obviously shaved off a little bit yesterday. Gold is up 13% year to date, 6.9% in terms of real returns, while crypto and ether. Now, remember, I always warn people, these are highly volatile assets. You use them in smidgens. Okay, I always tell people 90%, 85%, but really it should be 90% of your portfolio should be tried and tested simple assets. This morning, let me actually put this out for people. This morning, I said Dave Ramsey was having, I think yesterday, Dave Ramsey actually posted up something where he said, people, the way to wealth is usually a very simple path. It's not easy, but it's simple. And I want to just differentiate those two words for you. Simple means something that is clear. It's just got a few steps. If I tell you, Vernon, take here's a 50 kg rock, lift it. It's a simple task. It's not easy, because easy is about the amount of effort you exert. Simple is the steps you need to take. Okay, that's all you need to look at. Simplification, even in mathematics, is about bringing something to a single state. People will say, represent this equation in its simplest form. In its simplest form is x equals 2. 2 is a simple and clear thing to see. Okay, because we all know what 2 is. It's not x squared, this or that. It's x equals 2. That's really what you're trying to say. Okay, so simplification is bringing something to the simplest form. In other words, something clear that you can see. It's not many steps and many elements. It's one clear thing. So simple, stick to tried and simple tested processes. Now, Nassim Taleb basically said this: practice what's called the barbell. And the barbell simply means about 80-90% of your investment portfolio should be sitting in simple, tried and tested assets. If you're buying shares, buy the value shares, the ones that have been paying dividends consistently. 90% of your portfolio should be those things. If you're trying to invest, buy dividend stocks. If you're trying to invest as well, buy bonds. 90% of your asset portfolio should be in simple, tried and tested assets. Dividend paying stocks or value stocks, bonds, and rental property. That is where 90% of your wealth should be sitting. Okay, so that everyone understands that. Then the other 10%, he said, you can tinker away and experiment, because the one thing that goes right will have very explosive growth. But if you lose, you've only lost 10%. Okay, you haven't lost 90%. You've only lost 10%. If you just keep it that way, and when you lose, just make sure you're very careful not to have catastrophic losses. Okay, it's like allowing a baby to learn how to walk by bumping their heads, but not allowing them to play with a knife. You know, you don't want them to now to have a catastrophic loss in their life. So that's what you want. So make sure your portfolio is structured the same. So when you look at things like cryptocurrency having 63% year-to-date returns in Zambia, what that means is that should be sitting in the 5%, the 10%. That's your fringe assets. You're experimenting with them. Have at it. If you want to try online farming, by all means, have at it with like only 10%. I'm not telling you it's going to make a return on investment. I'm telling you, if you really, 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 really want to experiment, you experiment only with no more than 10% of your wealth estate. You don't go and put your whole kiddie pool in there because you're hoping to double and triple your wealth. That is how you lose everything. That is how you hurt yourself. Okay, yes, you might get lucky, but that's a very slim chance. Don't make huge wealth decisions on slim chances. 90% of your assets should be tried, simple, tested things. Things that have been around for decades. Okay, not things that pitched up last week. Things that have been around for decades. They've been tested, they've been running. Okay, the stock market has been operating since 1983. The bond market has been operating in Zambia since 1990. The bond market in general has been operating since the 1800s. The stock market in general has been operating since the 1600s. Okay, property has been around for a long time. These are things that have been around in the world for hundreds of years. Stick to things that are hundreds of years old. They're very anti-fragile. They've been around for a long time because there's a reason why recessions, all these things have happened, yet bonds are still around. Stocks have still been around. There's a reason why these things are there, people. Okay? The new stuff, it's exciting. It's wonderful. We talk about it. We seem so smart, but you lose a lot of money trying to put all your money in things. So if you want to experiment with assets, experiment with 10%. You can try and experiment in various areas, but keep your experimentation to only 10% of your wealth estate. I don't know if that makes sense to you, Vin. I don't know if we have you back yet, but I don't know if that makes sense to you.
Yeah, absolutely, it does. It's then try tested. If you settle for some days, I don't know if you're able to hear me.
No, we can't. You sound like a football commentator underwater. That's exactly what you sound like, my brother. You sound like you're
You can't
commentating
hear me.
football. No, it's very faint. Well, I guess we have to take the rest of this journey along, but I don't know if our tech team can be able to help out Vernon later on. Let's continue going into this. I am giving you, this is the 22nd, 23rd, so it's time to give you my oil prediction or what we're expecting to see from the oil markets. Based on what we've seen, expectation is that it's leading towards either staying flat or a 3.37% a 3.77% decline in prices. That is what we're expecting. A 3.77% decline in prices in oil, or at least it stays flat at the worst. So expect the price to stay flat. So simple test, Vernon, we just have to say is if you're driving around this week and you don't see people doing this at the gas station every single time, that means that the prices are going to go down and stay the same. So they're trying to offload. If you see them doing this a lot, prices might start going up, because these guys I think they know what's happening very early. So it depends on what they're seeing. So the oil marketing companies kind of give you the signal. But on one other route, but just one other piece of news which I actually picked up for so many people, I was actually moving around on Saturday, and for the first time, I saw a petrol station accepting mobile money for the first time. And I'm saying that is where the change is going to come. But unfortunately, the people who run booths for a business, that might be a very tough one. The only customers you may have if you're running a booth for a business is this: the people who maybe sell vegetables and stuff like that at the markets, people who are doing if you're doing orders for people, that might be your only option. If you are doing orders, this is how your business might work. If, let's say, somebody wants to deliver bread to a marketplace and they tell the person running the booth, please take everyone's orders and then send me the money, then I'll come and deliver the bread. That might be your only business. So people who are market agents, that might be the only way to do it. But if you are trying to operate a booth for the fact of cash and deposit, there's a lot more stores that are now taking direct payments by mobile money. Even the people who sell vegetables on the side of the road, Vernon, are starting to take payments by mobile money. So the more we're doing mobile to mobile transactions, the less you're going to see the need for people to withdraw. Okay, and this is where the struggles may come for them, because online taxi drivers, the online taxi app, the taxi app drivers are accepting money payments via mobile money. Marketeers are accepting payments via mobile money. Stores are accepting payments via mobile money. That little device that now allows you to be able to pay. Restaurants are accepting payments via mobile money. So we're actually seeing a lot more commerce happening directly with mobile money in Zambia. So that is meaning that the booth business, in as much as we're thinking, how are we going to clean up the streets? And I said this last year. People are saying, how are we going to clean up the streets in this country with all these booths? I said the natural state of technology will do it. The more people transact directly, the less that business even makes sense to those people, and those booths will eventually become abandoned. That's the reality. Okay, so when the booth is not making money, people are going to leave, and therefore we'll have no more booths on the streets. It happened in China. They had those booths. Then people started doing mobile to mobile transactions. And the more they did mobile to mobile transactions, the booths just shut down and people just switched to the next business opportunity. That's literally all that's happening. So eventually, I think those who are looking at booths as business, think very carefully, because what's happening is that people are transitioning. Now, there are some banking agency businesses that are happening. So if you're going to be a specific telecom provider's booth, you might have a problem. But if you're going to do banking services, like for each of the banks who are offering agency businesses, then maybe. And if you're going to do order processing for markets, that might be your way to kind of stay into business. But that's more of a smaller group of people, a subset of people. But what you're going to find, Vernon, is cash trading is going to go down. Next week, people, I will be going through the payment systems statistics for Q1, and I'll also be going through the banking sector statistics for Q1. Sorry, not next week. On Thursday, I'll be going through payment statistics for Q1, banking sector statistics for Q1, as we've got them out for the BOZ, especially for banking sector. And finally, Vernon, in our roundup today, we are looking at what we're looking at from the Four Horsemen. Not much news came out yesterday. Korean consumer confidence rose yesterday. EU consumer confidence declined continuously. US short-term interest rates are up as debt talks draw closer. Japanese PMIs jumped for the first time since November 2020. There is a positive sentiment in the Japanese manufacturing sector, while industrial production in Switzerland dropped from 5.7% to 3.5% growth, while the construction industry in the EU has declined. Main stories that are coming out yesterday, and we'll go through some of them. US to invest $250 million million in the Lobito Corridor, which is going to be our main story we'll touch into. Zambia Association of Manufacturers has actually been pushing, and this I think this is big. Go big or go home. They're pushing for company taxes. In other words, the company tax rate, which is tax on your profits, to drop from 30 to, listen to this, Vernon, 15%. That's the level, actually, by the way, that they do give farmers. So I think some farm companies do get 15% to encourage agriculture. So there are already some industries we already give this rate to, but they're trying to say, look, if you want to improve this country, they're saying drop VAT to 14%. I can see some of the windows there might start celebrating, even though I believe, Vernon, that I believe in, what was his name? Herman Cain. Herman Cain said 999, but he said that government taxes should be 9% flat. Whether it's VAT, whether it's sales tax, whether it's income tax, the government should not collect more than Jesus. Okay, if I'm giving Jesus 10, government better get 9. That just might work out. That's another conversation for another day. But I have actually said that we should consider a flat rate. But they're also pushing for tax exemption for pharmaceutical inputs to improve domestic pharmaceutical manufacturing. We're talking about that because, Vernon, remember that we're currently having a problem with importing too much medicine at too much of a high cost, and it's affecting our FX rate. So it might be a good idea to stimulate pharmaceutical inputs import, so that people can start producing some of the pharmaceuticals in here if we can. A record number of British firms are pessimistic about doing business in China. I'm going to go through that story in detail later. While we're seeing oil holding, gold holding because of the debt talks, Japanese real wages had fallen to the most in 8 years, while the outlook seems brighter. Analysts expect real Japanese wages to go up as the economy recovers, inflation eases, and the job market remains tight. While Vitalik Buterin, who is the head of Ethereum, has actually said, "People, let's not try and stretch the system. We might have a few problems." He wrote a blog post stressing the issues of testing the system. And Vernon, let's get into our main story for today before we take a break, is that the U.S. is scheduled to invest, is saying that they're looking and assessing into investing $250 million into the Lobito rail corridor to link Angola and DRC. To date, the U.S. has mobilized about $30 billion to build out transformative economic corridors around the world to boost and connect economies. Right now, America is threatened by what China has been doing with infrastructure. So right now, ironically, as China is building up oil refineries in Angola, America pops up with $250 million. Say, hey, how about we help you build that railway line that you've always been trying to do to get things to the DRC? Because remember that's been the difficulty, Vernon. Sorry about that. I don't know if you're able to hear me.
Loud and clear.
All right. That's been the difficulty of actually getting oil out of Angola into the rest of the world, into the rest of Africa. So Angola has found it easier to take oil out into Europe as opposed to taking it into Africa because they've had no way of connecting. So the Lobito Corridor is a very important one because, yes, they're saying it's for agricultural products and stuff, and also will help because maybe if we can get that corridor going, we can get agricultural products like beef or anything, and they've been asking for our beef for some time to places like Kolwezi, and then trade that directly to places like Kolwezi, which is just at the border of Solwezi into DRC, and then send that to Angola. So it actually opens up trade to Angola very well, and a trade with Angola. But I think one of the best things for us is that if they do open up this corridor very well, one of the main things is that it'll open up a lot of trade of oil. Now, remember what we're waiting for is 2026. There's this Sino Angol refinery, which is supposed to go online that Zambia has invested in. So if you have the Lobito corridor opened up and you then create the Solwezi-Kolwezi road path, that means you can get oil that flows through that railway, connects from Solwezi to Kolwezi straight into Zambia, and you got much cheaper transportation of oil that has entered through that area. So this is actually adding to the case that we might have less pressure on our currency going forward, mainly because of this. That's why I said if you're looking at 2025, 2026, copper is expected to be up around that period. Oil is expected to come down, or oil is expected to be cheaper because we have a different source which was scheduled for 2026. And by that time, we're supposed to be self sufficient with fertilizer. So, three things are going to converge to strengthen the currency by 2026. And obviously, we'd probably, most probably, have our debts resolved by then. So, these are the major components that will actually come into play to have a stronger, more consistent currency and also allow for much more growth. So these are the things you should be looking out for in the next. That's why I said a strong kwacha may not be a 1 to 2 years thing, but 2025, 2026, that's when you should be looking at a case for a strong kwacha going forward. However, there is one more thing, Vernon, I think is up with this case. I think people may not be seeing what's in it for the US. Americans are capitalists. They make decisions based on what's in it for them. So,
Yeah.
what is in Congo that China is getting its hands on? I'll tell you, cobalt. Okay. Right now, as it stands, cobalt can only leave through Zambia going south up or going east to China. That's the only way cobalt can leave DRC. You put a railway line to Kolwezi going in Angola, plus they're also making investments in Angola. Guess which direction cobalt can also move in? West. So that makes it easy for them to get hold of cobalt that can, instead of going straight east, can now go west. And now they can compete for what's it? For DRC cobalt. And then the EV power struggle continues. So you see what I mean, Vernon, but there's always a second thing. Wherever this is the benefits I was telling you to the Chimerica battle. When China goes into a place, America is going to follow. The same way we used to see with the Cold War. So now China has been there setting up refineries and trying to help in Angola. They've lent about 250. Angola is the number one group who China is owed money to. Not 250. They owe about $40 billion to China. So Angola is already the biggest one. So when you start seeing China in there, America pitches up and says, we'll build solar panels for you. We'll build that railway line that you need. Why? Because they're looking and saying your next door neighbor has a mineral that if we don't get our hands on it, these Chinese get their hands on it, we're going to have issues having that stuff for our electric vehicle development. So what's going to happen? There's now going to be that struggle for cobalt moving between east and west. That might affect your exports. Okay, because now cobalt and copper having to come through Zambia may not be such a thing. But I'm just telling you, that's the game that you see. I don't know what your thoughts are before we go on our break.
Yeah, it's still, I'm not sure if you're able to hear me now.
Yeah, I can hear you. I can hear you a bit, but just keep going. Yeah.
I'm not sure what really the challenge is, but I hope we'll be able to pull through. So essentially, this still, trickles down. America is a country. It is powerful. It has resources. But the moment you lose sight of what you have yourselves, because they are always on the lookout of what they're able to pull out from a country and benefit as a country. And I think this should equally be the context for everyone as you're going to get into bilateral, multilateral, agreements and whatnot. Be on the stakeout and look out for what the other person is in for. Sometimes I feel we get a bit too excited, to get into agreements with the Europeans, maybe America, because we're looking at what they're giving us and forgetting how much they're probably going to benefit from whatever we give out to them. And this is why you find that we actually do export a mineral resource from the country, have it given out to the whites. They go process it, produce a product, and return it back here in Zambia, and we buy it ourselves. We could actually be making the same products ourselves. So I think America, I can't blame America. America is just about trying to earn whatever
Yeah, take care of their people.
profit. You know what I mean? They see opportunities, they go for it, and they see doors open, and they offer you for something, and then it's not like they're stealing. They come to you and tell you, I'm gonna give you this, you give me that, and we agree. So you can't really blame them. But it's really gonna, come down to us if we're able to understand what we are able to offer to the world, and see how we can, be able to benefit ourselves, create something from them. And I think it would be best if we are selling them the end product and not selling the unfinished product. Then they go make something out of it, and then we can buy it ourselves. Uh, we don't need to rediscover ourselves. I think there's more we don't know about ourselves as Africa.
And we'll leave it there, Vernon. We'll be back on the other side. So everyone stick around. We'll be back in just a minute as we take one ad break to come and round up towards the end. You want to stick around. I want to talk you through the big mistake everyone makes with their pension. Okay, those of you who've got pensions that you are withdrawing, not just NAPSA, workplace pensions when you leave, you want to stick around for the other side of this conversation. And welcome back. Welcome back. Thank you, Vernon, for getting us back on. And today we're gonna finish up what some of the main stories for today have been. Record number of British firms feel pessimistic about doing business with China. So remember, I said you've got this east-west shift that's happening anymore. They're no longer this big happy family colonizing us together. They're now fighting each other. So we should be able to now work on the cracks that are in here. Strained geopolitical relationships, slowing global economy, and growing talk of self-sufficiency and shifting investor perceptions are at the top of the challenges that businesses are facing doing business in China from the UK. 70% of companies are saying it's too early to make long-term commitments to the Chinese market, and they have seen foreign direct investment into China slow substantially into the year, as low as 3.3% decline in FDI going into China. And what do the Chinese say? Like, we care. Like, that's what you're seeing from them. They actually don't care anymore. If anything, to me, the Chinese seem like Tupac about to sing "Hit 'Em Up" back to Biggie. I know that reference may be way a bit too old for you, Vernon, but that's all right. Don't worry about that. Or you may want to pretend you're a good church boy who's never heard such. But effectively, they just sound like they're screaming "Thug Life" till they die. Now, the next thing we're also seeing right now is Shanghai warehouse copper stocks are down 13%. This is the signal I keep talking about, that we're going to see a copper deficit coming soon. Although in the short run, there is sight that we might see it in the second half of the year. Global copper markets are expected to see a deficit this year, steered by improved Chinese demand. The International Copper Group study forecasted a deficit of 114,000 tons for 2023 compared to the surplus of about 150,000 tons expected last year, mainly due to higher Chinese usage. But it is expected that in 2024 there'll be a surplus, and then from there going onwards there'll be a deficit, a growing deficit, because of the amount of electric vehicle demand. And that's all the main stories for today. And we get into our chart of the day that gets into our stories of the day. So if you take a look at this, Vernon, this is a chart extracted from the Pensions and Insurance Authority's annual reports of what are the percentage of pension withdrawals as a percentage of the number of contributions. So contributions is the amount of money we put into our pension funds, and withdraw is the amount of money we can take out. As you can see, Vernon, 50% of the money that goes into pension funds goes out. So it's like people putting money into their savings account and withdrawing half of it. This is the number one reason people do not have wealth when they retire. It boils down to this: they withdraw too much money out of their pension funds. Now, usually, this is what people may not understand is you do have the allowance to withdraw money from your pension fund when you leave your employment. As part of the Constitution of 2016 amendment that was signed, everybody has the right to claim their pension on the last day of work. And in fact, the employer is punished if they don't pay their gratuity, leave days, and pension of an employee on the last day, because that employee remains on the payroll. Okay. So if you leave work, if let's say, Vernon, you give your employer 30 days notice, on that final day of work, if you have not received if you're entitled in your contract to a pension, a gratuity, whatever, if you don't get that pension in your hand, the next round of salaries, you are still on the payroll. Okay. Until they've paid you that pension. So if they say, no, no, Vernon, we'll pay you in 2 months, great. I'm going to sit at home and you're going to pay me my salary for the next 2 months still until I receive that pension. So that is what is actually happening. That is actually a law that actually pertains. Now, as a result, a lot of employers have made sure that they make payment to employees, and people now have the option to withdraw. And plus, your pension is tax free. So on top of it, it used to be your part. So whenever you contribute to a pension, it was your part and there was the employer's part. Because your employer would put in some money, you would put in some money together. That would be your pension. That's called an occupational pension. Only about 120,000 to about 150,000 Zambians have that. Okay, in Zambia, 950,000 people are on NAPSA. That's a different story. But NAPSA also is two contributions, you and your employer put together. But generally, in the occupational employer base, we do that. The old law used to be that you can withdraw your part tax free, but your employer's part that they put in, you were taxed at highest rate, which was 35%. That was the old law. But up until 2016, that law then changed and it was tax free. And then we saw this. 2015, 2016, look at that jump from 24% of contributions being withdrawn, bam, 52%. And we have been there. This 86% is because I think the previous years we've actually seen a few mines liquidating pensions, and these are huge mines. So you're seeing that, Vernon, on average, 50 odd percent of the since 2015, 50% plus of money that is supposed to go into people's retirement accounts is being drawn out. Okay. And this is the reality that we're facing. It's not pension benefits drawn out pre-retirement. Now, that money doesn't go to other assets. So some of my clients, when they will call me and say, hey, Munyumba, I've got my pension. What should I do with it? I structure and say, let's buy a few bonds. Let's get some stocks. Let's make sure we have a self-managed portfolio, because now you're going to be on self-management. Gratuities are even worse, by the way. People buy cars with gratuities. So the reality is your pension and your gratuity should be going to the assets that will take care of you in retirement. Remember, I said you've got 5 investment goals: harvest, health, higher education, home ownership, huge purchases. And they're in that order. If you don't have a retirement harvest, those last 20 years of your life are going to be so dangerous, because you don't have income generating capabilities anymore called a job. Your business may be limping at that point, but remember, you need to make sure that you've got harvest capabilities. So because you're withdrawing too much, that doesn't help you. The number one reason, Vernon, why most people do not have adequate retirement is not because the markets or the interest rates or the system, it's because you're not putting any money in. It's that simple. Okay, you're not putting any money in, you're taking too much money out. It is that simple. Finish and clar, as the Afrikaners used to say. So the more you keep your money in and invest it, the people who just keep investing and keep their money invested are often the people who have the most money when retirement comes. Now, yes, there's other factors like your salary, all these things, but really it boils down to the number one habit is withdrawing is going to be a problem. Now, if you're withdrawing to self-manage your portfolio, that's different, Vernon. But if you're withdrawing to chew, if you are just eating, hey, yeah, that's going to be an interesting situation for you at retirement. Because everybody pretends like retirement isn't coming. It's coming, people. The average Zambian is going to live up to 70. The average Zambian man is going to live up to 71. The average Zambian woman is going to live up to 79. You're going to retire at 65. So you're going to contend with 10 to 20 years of retirement. That's life. Okay? You're going to be around for a long time. Actually, Vernon, in fact, if you make it to 60, the probabilities now you're going to make it to 80, they get even higher. Okay. In fact, people who just get past like 50, majority of them going to like their 80s and stuff. So if you make it past then, that means you're going to have to fend with retirement. That's going to be an issue. So keep as much of your money for those days, because you are not going to work. You don't know what economic state your children are going to be in. That old African assumption of my children and my retirement was an assumption that used to be made on the agricultural economy, because you used to have farmland. Your children, you retire, your children then take over the farmland and feed you off of it. There was an asset already in play that was able to take care, and your children just had to take over it. Now, bringing that assumption to the city is dangerous, because you are relying on a job market that has proven that it's all over the place. Industrial revolutions, over what's it, poor economic management, all sorts of things are trickling in. Costs of borrowing, they affect the ability for people to create jobs in the economy. So manage your retirement, people. I know it seems far away, but do not let the excitement of today take away from the fact that you will one day have to retire. And if you don't have the assets to do it, you are going to have an issue. Starting a business in retirement is dangerous. It's difficult. Okay. You don't have the energy, you don't have the capacity to make mistakes, all those things. That is very dangerous. So keep your assets together. Bonds, stocks, rental property, proper rental property, not high-end rental property where you won't have a tenant. Speak to people like Mr. Fumbeshi. He will explain things to you as to where to put money in terms of the rental industry. He will actually tell you which are the ones to be acquiring. So that's just something I wanted to put into people's minds, that this withdrawal rate that we're having here already tells you this. And by the way, this is the pensions market. These are the people who you're expecting to be, these are the most financially literate people. Okay. These are the wealthiest people and the most financially doing this. So it already tells you why we've only got 800 to 1,000 millionaires in this country. This already explains it to you dead on. Okay. Why the wealth base of this country is so weak. Now, in African data, here's some data for us to look at. This was our topic of discussion. Only 19.8% of Africans above the age of 60 years or above retirement age are actually actively receiving a pension. The other 80% are fending for themselves and dealing with it and expecting it from their children. So this is much lower than the global average of 77.5%. This is the extent of black tax, by the way. This is what it means. Okay, this is why we have the black tax situation in the first place. Is because only 80% of the retired population are being taken care of. We don't know how. Okay, but but in the developed world, 77% of the retired population are being taken care of by an actual pension payment. So they don't need their children. They don't need everything. They're able to be taken care of. The cause of this is obviously low income, high informality rates, high levels of financial illiteracy, and poor information on the benefits of actually contributing and keeping your contributions in pension or in assets. Now, remember, only 9% of Africans in the labor force are actually contributing to a pension scheme as we speak. This is much lower than the global average of 53.7%. So already you can see where the problems are coming from in Africa. Now in Zambia, this is obviously data that we've extracted. Zambia, less than 11% of the retired in Zambia, it's worse, by the way. That was 20% of the retired population in Africa. In Zambia, it's less than 11% of the retirement population in this country is receiving a pension. Okay, this is lower than the average of 19% for the region, 19.8% and 77.5% globally. 29.8% of the labor force of this country. Now remember, the labor force of this country, Vernon, I'm counting the fact that only 1 in 3 Zambian adults is actively working. Only 1 in 3. So out of that group of 1 in 3, only 1 in 3 of them is contributing to a pension scheme. So it's 1 in 3 of the 1 in 3, okay, who are actually contributing. So 1 in 9. 1 in 9 Zambian adults is contributing to a pension scheme. Only 3.7% of that labor force is contributing to an employer-backed pension scheme. By the way, NAPSA is only ever going to cover 20% of your retirement needs unless you're on the lower spectrum of income. If you're on the higher spectrum of income, it's going to be about 20%. About 60% of that work has to be done by your occupational pension. So if your employer and you are not having a pension scheme, you better be saving money for your retirement, because 60% of that is going to be done by your personal investments if you don't have an employer-based pension scheme. So think very carefully. Now, the only thing that might help us for Africa is the percentage of Africans. This is just a chart quickly to show you the percentage of Africans above the age of 65 has been dropping, especially Zambia. You can see 1.7%, but that's going to pick up over the next 20 years due to our aging. Because of good health care and the way we've actually managed to get rid of a lot of the mortality issues, we're going to see that number increasing. And the bigger the percentage, the bigger the issues. Africa, you can see it's leveling off and picking up. Look at the world. It's gone from 5% to 9%. Aging populations are the main issue. So, Vernon, I will leave you with that final thought for people. Your pension is not for chewing, people. It's not for chewing. Okay? It's for using properly. It's not for chewing. I was going to show you a very quickly, Vernon. I know I'm eating into time. Very quickly, 1 minute. This is a video from a group called Abound Wealth. In fact, no, people. I'll keep it for tomorrow. You're going to see this tomorrow, where we're going to talk about looking rich versus being wealthy. Okay, that's going to be the conversation tomorrow. The thought of looking rich versus being wealthy. So to everyone, I wish you all a wonderful day. God bless. We've lost Vernon at the end, but have a good day.